Well, good morning, everybody. My name is Greg Sizemore, and I'm the Executive Vice President of the Construction Users Roundtable. And on behalf of our organization, we welcome you to yet another installment of the Construction and Crisis Seminar. This one's called Back to the Future and very, very informational. We're excited to hear what Anirban has to share with us in just a few minutes. Before we get started, however, we want to thank our sponsor, and that's NCCER, without whose generous support these free webinars would not be possible. So NCCER, thank you so much. We'd also like to thank you, the CURT members. You have been so faithful and loyal during this very trying time, this past 3 or 4 months. And we thank you so much for joining us and enriching our time together by participating and being a part. I want to tell you that the purpose for these seminars is to make you, the construction industry leader, a better, more well-informed, well-connected decision maker. That's its purpose. We've always said that CURT's purpose was to share perspectives, experiences, and resources with one another. And that, of course, is what we're doing in this installment. I want to invite you to mute your microphone if you wouldn't mind. There'll be time for Q&A shortly. And if you want to activate your video, please do so. It makes us feel more together and gives us a sense of presence and a sense of being together. So if you wouldn't mind, thank you. So many of you are doing that for us, and we're grateful. I want to tell you that also later today, you'll receive an email that has the PowerPoint slide deck on this presentation, as well as information on our speaker, contact information, etc., and other information that we think you'll find helpful. So if you'll give the team here at CURT some time to pull that together, you'll be receiving that generally by the end of the business day. So we thank the CURT team for pulling that together. Our format today is quite simple, and you're probably very familiar with it. We'll have a presentation for about 30 to 40 minutes, then we'll have about 20 to 30 minutes of Q&A. I invite you to use the chat box. Most of you are likely familiar with Zoom. Those who may not be, the chat box can be found if you just hover your cursor over your image there. You'll see it appear in the very bottom center of your screen. It says chat. And anything that's mentioned, contact information or whatnot, please put your questions in there and any information you want to share with the greater group. I think that's all the preliminary announcements I want to make, other than to remind you that we are going virtual for the August meeting. We're erring on the side of caution and following the trends of some other groups and organizations who are doing the same, but we will have a virtual series of meetings in August, just like we did in May. They worked beautifully. We've gone back and even improved them more so than we had in May. But that agenda for the series of meetings in August, beginning on the 24th, can be found at curt.org/events. That's curt.org/events, and we'll invite your attention there. Anirban is with us. As you folks know, he is one of the more well-regarded economists on construction in the country, frankly. We consider him a personal friend of CURT. He's chairman and CEO of SAGE Policy Group. You'll receive contact information for that crowd at the end of the day in the follow-up piece. And they are quite simply, an economic and policy consulting firm that's headquartered in Maryland. I could go through a plethora of accolades, recognitions, and awards that Anirban's received, but we're not going to spend time on that. His complete bio will also be sent out to you in this afternoon's email follow-up. Anirban, welcome. The world has changed remarkably since you were with us at the end of March. We invite you to share what we need to know to become a better, more well-informed decision maker in this industry. Anirban Basu.
Righto, thank you, Greg, and privileged to be with CURT stakeholders today. And you know, I plan to shorten the presentation just a bit today, more like 30 minutes as opposed to 40 minutes, because you know, I've spoken to CURT stakeholders a lot in the last year or so, and I want to, you know, keep things fresh. I keep having to update my theme because I'm speaking to you so often. So I've done a Lord of the Rings presentation. Today is a tribute to 80s movies. tribute to 80s movies called Back to the Future, and hope that life returns to normal sooner rather than later. So thank you again to Kurt, and please, as I go through this material, or even now, put in your questions, because I think we're going to have a lengthy Q&A session today to really find out where we were. Now, when we last got together, I'm not assuming everyone was with us in late March, but when we last got together, the crisis had just begun, effectively. I would argue to you that the crisis began on March 9th. Anirban, you're wrong. Right off the get-go, right off the bat, you're wrong, because they call it COVID-19. And it called COVID-19 because it was discovered in 2019. So the crisis did not begin on March 9th of 2020. The reason I say March 9th is that's the day that the US financial markets noticed that there was this public health crisis, and it was actually registered in stock prices. The week prior to March 9th had been choppy in terms of trading. But on March 9th, the Dow Jones falls more than 2,000 points. And at that time, that was the largest daily decline in Dow Jones history. We also set new records on March 12th and on March 16th. And that's when I think many economic stakeholders realized, my goodness, this is going to bring this economic expansion to an end. There had been some naivete coming into the period, by the way. You'll still see some quotes if you look back in late February and early March from economists indicating that this public health crisis need not result in a recession. Nonsense. We shut down the economy. But the notion was that the economy was an irresistible force, that we had an unemployment rate of 3.5% coming into the crisis, a 50-year low. You'd have to go back to December of 1969 to find an unemployment rate as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Orioles were good back then. We had a job growth for 113 consecutive months. We had a booming, raging stock market, rising property values, and of course, and I'll show you data on this later, very solid non-residential construction spending. So that's where we were. But this irresistible force hit an immovable object. That immovable object is COVID-19. There had been some talk, you might remember, as late March when we were together, that warm weather would be the antidote. That the virus didn't like warm temperatures. And perhaps it doesn't. Perhaps it likes cooler temperatures more when people are sneezing and coughing and so on and so forth. But you can see, if you look at hotspots there around the world, near the equator, away from the equator, whether it's Siberia or northern Canada or Mexico or Brazil, Western Africa. I entitled this slide, "Say Hello to My Little Enemy," as a nod to Scarface, a 1983 movie starring Al Pacino, where he said, "Say hello to my little friend," as it turns out. His little friend was not little. I don't know if you remember the movie. But in any case, you can see nationally as well what the hotspots have been. And one of the things that has done, the spread is that, okay, in the Northeast, where I am today, the number of cases and hospitalizations has fallen significantly. But in Florida, Texas, and other parts of the country, particularly in the American South, of course, we're seeing a spike in cases. So we're still very much in the midst of this. More than 400,000 deaths globally, more than 115,000 nationally. A recent forecast came out for a prominent university suggesting that by October we'll be over 200,000 deaths in America. So, I want you to please understand that even though I've been asked by Kurt to speak up about the economy, I, along with you, view this first and foremost as a public health crisis. In some sense, the economic damage is secondary to that. A lot of people will not recover. They have lost their lives. Many of us have lost loved ones as well. So there's that. Now, maybe some good news here. So if you look at where we were in late March, we were just kicking things off globally in terms of confirmed cases of COVID-19, just kicking things off, marching into the great unknown. How bad was this going to be? So on and so forth. We knew it was going to be bad. It was at that time, almost exactly at that time, it was released on March 24th. The Federal Reserve Bank of St. Louis assessed what fraction of the workforce was at risk of layoff because of social distancing directives. And in their study, they included 147 million jobs, and of those 147 million jobs, they deemed 46% of them to be at high risk of layoff. This is workers at retailers, restaurants, hotels, so on and so forth. And sure enough, those have been the workers who have been hardest hit. More data on that in a moment. But the good news here is this, that here we are, roughly 3 months later, and we're flattening the curve. We've flattened the curve in various parts of the country. In fact, you might have noticed that New Zealand is COVID-19 free, and they're starting to have sports and stadiums with actual fans, not wearing masks. Life has returned to normal in many ways in New Zealand. And so I hope that that's part of our future. And we are starting to see some of this flattening of the curve globally and in the Northeast and other parts of the country. So that's very good. But let's talk about the economy. And unfortunately, the economy has really been devastated by this. A lot of people have been forced to take a day off. Now, Ferris Bueller voluntarily took off a day, you might remember, in his hometown of Chicago. Unfortunately, a lot of people have had to involuntarily take days off. Well, let's talk about some of these dynamics, shall we? So you've probably heard this, that since the crisis began in earnest, 43 million Americans have filed for unemployment insurance. The unemployment rate at 3.5% pre-crisis rose to 14.7% by April, just 1 month later. You know, because some of the monthly and quarterly data were slow to reflect how devastating, how quick moving the pandemic was with respect to its economic impacts, a lot of us have been fixated on high frequency data like these. This is initial claims for unemployment insurance. Now, during the week ended March 28th, so that was right around the time that we were together last, to the extent that we were together, March 28th, nearly 7 million Americans that week filed for unemployment insurance. You do the math on that. I mean, you may not agree with anything I will say or anything I have said, but I think we agree that a week has 7 days. So if 7 million people filed for unemployment insurance, that's 1 million Americans per day. Now, we had fewer than 5.8 million unemployed Americans coming into the crisis. And then you've got a situation where 1 million people are filing per day for an entire week. As I say, in aggregate, 43 million Americans roughly have filed for unemployment insurance since the crisis began. But here's some more good news. During the week ending June 6th, which happens to be my anniversary, 1.5 million people filed for unemployment insurance. Now, look, something's very wrong when the economist says that's good news. Because pre-crisis, it was 210,000 people filing for unemployment insurance at any given time, about 210,000. That's that blue segment that you're seeing there, before the red, before the crisis. The 1.5 million is still very elevated, but it's falling. You can see that fewer and fewer and fewer people are being dislocated. We are returning to normal. And here's the thing. This data series can be misleading. Why? Because it is conceivable that someone could lose a job today, file successfully for unemployment insurance, let's say the next day, and then get a job the day after that. I'm not saying it happens often, it's conceivable. So what matters more than initial weekly claims is continuing claims. And here we see some progress. So you can see that the absolute number of people on unemployment insurance, and this is for the week ending May 30th. These data are lagged by about a week. In fact, they are lagged by a week relative to the initial claim. So that's why I'm showing you the week ending May 30th. I'm not trying to hide anything. But these data show that, in fact, the number of people on unemployment insurance has been declining recently, which was a hint that maybe the May jobs report would come in better than anticipated. And that's exactly what happened. More good news. Now, this is monthly job growth in America through May of 2020. The May jobs number was the most surprising statistic, I would say, in the history of economics. Because coming into that May jobs report, which was released last Friday, or during a previous Friday in June, coming into that jobs report, economists surveyed, and mostly Wall Street economists, estimated that we would lose 8 million jobs in May, that we had lost 8 million jobs in May. What did the number come in at? Positive 2.5 million. Now let me walk through this slide a little bit because it's a little complicated. What we've done for you here is we've indexed the April 2002 through February 2020 data on the left. That's in the left axis, the blue bars. But we put March, April, and May of 2020 on the right. That's indexed to the right. Why did we do that? Why did I have to do that? Because in April of 2020, the nation lost 20.7 million jobs. And in that 1 month, therefore, we wiped out basically all of the job growth we had over a 113-month winning streak. A 113-month winning streak during which it didn't matter if we had presidential elections or Houston was underwater or whatever the circumstance, we added jobs for 113 consecutive months and 22 million jobs over that period. We lost almost all of that in 1 month, April of 2020. And so if I tried to index all of these monthly data on one axis, basically the lines just disappear. So for instance, in March, which is the first of the red lines, it's a little bit, it's below zero. We lost over 800,000 jobs. But looking at that, you say, oh, that was okay. We didn't lose too many jobs. We lost a bunch. But it's just April was just so devastating. And then, I mean, it's really good news if you think about it, because economists are saying, okay, we lost 20.7 million jobs in April. We're going to lose another 8 million jobs in May, but it came in at positive 2.5 million. And one of the things I had said to you in late March, remember, I mean, we didn't know anything at that time, but one of the things I said was, there's this big debate about whether it's going to be an L-shaped recovery, U-shaped, check mark, Nike swoosh, V, so on and so forth. And I said to you, it's going to be a V. I said to you, and I didn't say that just to play to the audience and try to make you feel better. I said that because we have seen from previous pandemics, for instance, Hong Kong, 2003 SARS, so on and so forth, that advanced economies have recovered very quickly economically. Not complete recovery, mind you. But the initial phase of recovery was explosive to the upside. And that's what we had, predicted. And sure enough, by May, and I had not predicted that we're going to add jobs in May, by the way. I was surprised by this as well, but I wasn't a negative 8 million. Sure enough, by May, the recovery had begun. Did you see retail sales numbers today? The expectation was that retail sales numbers for the last month would be up 7%. Retail sales, what were they up? 17%. Why would one predict the V? Because we are human beings. We want to get back to it. We want to live life the way we live it. Sometimes we jeopardize our lives living the life the way we want to live it, right? You see all these kids walking around without masks and, hugging and all this kind of stuff, it's no surprise, after spring break, infections rise in Florida. Who didn't see that coming? But that's a reason to believe that this thing is going to come back very quickly. People want to get back to it. About 9 days ago, my family discovered that the Urban Outfitters in Towson, Maryland had reopened. The Urban Outfitters in Towson, Maryland. So guess who was having a great time 9 days ago at the Urban Outfitters in Towson, Maryland? My wife and 2 daughters were having a blast because they hadn't been to a store in a while, and they were shopping up. Guess who was having a perfectly miserable time at the Urban Outfitters in Towson, Maryland 9 days ago? Me. But the point is, people want to get back to it, and you see that in the retail sales numbers. Now, again, complete recovery will likely take years. So, Anirban, we lost jobs in March and April, and we're going to take years to recover? Yeah, you betcha. Because even during good economic times, there's always a group of firms, enterprises that are fragile, that are just making it, whether restaurants or retailers or so on and so forth. I mean, Forever 21 went bankrupt before the pandemic. Lots of retailers have gone, Claire's went bankrupt before the pandemic. Now, since the pandemic began, we've seen the bankruptcy of J. Crew and even Marcus, JCPenney, and so on and so forth. So what does that mean? You're going to see a lot of malls with uncomfortable rates of vacancy. You're going to see a lot of empty office suites coming out of this crisis. You're going to see a lot of empty storefronts. Because you, at any given time, have so many marginal players. And remember, one of the things we talked about during the first webinar is we talked about all that debt that corporate America had accumulated. So, a lot of debt coming into this crisis. When you've got a lot of debt, you need consistent cash flow. Keep making your debt service. But when you lose that, and COVID-19 cost us that, a lot of firms just can't make it. Ironically, you may see more retail bankruptcies after the end of this pandemic than during it. Why is that? Because one of the things that a retailer has to do after it declares bankruptcy is liquidate inventory. Well, it's very difficult to liquidate inventory when the mall is closed and people can't get to your stores. So oddly enough, look, recovery is a V, but it's for some industries erratic. Commercial real estate is one of them. Retail is another. But this gives you some sense of the jobs that have been lost by sector between May 2019 and May of 2020. At the very top, predictably, leisure and hospitality. That's your hotel and restaurant workers. Cannot deliver services when you're socially distancing. Can't do it. So that sector lost 6.7 million jobs. The second category here in terms of job loss is the category that includes retail trade. It's retail trade, wholesale trade, transportation, and utilities. Transportation, of course, includes the airlines, 2.8 million. So in many cases, who lost their jobs? The people who lost their jobs, in many instances, were the people who are most vulnerable economically. They're working in retail and at restaurants. They're making around their respective states' minimum wage, maybe a bit more than that. And so if you thought that there were significant socioeconomic disparities coming into this crisis, those disparities widened. And maybe there's a racial component to that. There's certainly an income component to that. And maybe some of what we've seen on the streets of America recently has an economic component to it. There's frustration there along multiple dimensions. But set that aside, 17.7 million jobs have been lost on a year-over-year basis, May 2019 to May of 2020. So the unemployment rate, which had been at 3.5% pre-crisis, is no longer 3.5%. It's at 13.3%. True. In April, it rose to 14.7% and then fell in May. That's great news. Yeah, absolutely. Arguably, recovery has begun. Now, every economic expansion cycle is different. Every recession is different. Here, I'm showing you three rates of unemployment. I'm showing you men in blue, women in green, overall in red. So during the previous downturn, the Great Recession, men suffered relatively more. Their unemployment rate rose farther and faster. And that's because many men are associated with production industries like construction and manufacturing, and those industries really took it on the chin during the Great Recession. So male unemployment peaks well above 10%, and takes longer to recover as well. This time was different. Women were relatively impacted, relatively more impacted. Women tend to be more aligned to industries like leisure and hospitality, retail trade, daycare centers, schools, all of which were shuttered. Many women were on the front lines of delivering care during the worst of the crisis, let's say in New York or elsewhere. An easy majority of American nurses are women. And so as the crisis, became more dire and continues to become more dire in certain parts of the country, it was women who were at the front lines and who became sick themselves and therefore lost jobs, at least for a time, because of that. So the unemployment rate overall for the nation, as I say, is 13.3%, but for men, it's around 12%. For women, it's about 14%. Construction was deemed in much of the country an essential industry. Even with that, it still lost nearly 1 million jobs in April. Now, if I'm going to give you an economic forecast, then I have to think about the public health outcomes, right? Because there's no way that we can have a smooth economic expansion if we don't have good public health outcomes. So I'm going to go through that, and in fact, as I was, talking with Greg Sizemore about, a half an hour before the webinar, we talked about the fact that the market was up 780 points. The Dow Jones was up 780 points. The Federal Reserve Chairman, Jerome Powell, is speaking right now, saying some very interesting things, apparently, and so the market is going up 460 points. And one of the things he's been talking about is, well, we can only have a recovery if the public health outcomes are good, which apparently reminded investors that they may not be good. And so that's a cause for concern. So here I'm graphing for you U.S. projected total deaths due to COVID-19 through October 1st. And you can see the solid line there in this what is that color? Marigold? Whatever it is, that solid line is history. It's actual data. And then the dotted portion is a forecast. And basically the dotted line is the baseline forecast. But then you see this kind of light shade area around that line. That is the zone of uncertainty. That's the 95% uncertainty level. And you can see it's a really large zone of uncertainty. So that, at the end of that tail, that 95% likelihood, we're talking about close to 300,000 deaths in America by October 1st, as opposed to the baseline projection, which is closer to 180,000. So, we're still in this zone of uncertainty. Now, what have I based my forecast on in the interest of full disclosure? Look, this is it. We have many, well over 100 clinical trials and preclinical trials taking place. We know now what we did not know in March, for instance, or we know things that we did not know in late March, that remdesivir, which is a Gilead Sciences drug, has some clinical efficacy. We know that hydroxychloroquine maybe does not. And it's, so we know some things. But Pfizer has been talking about a vaccine by the fall. I mean, that's where the solution comes from. It's Pfizer, Merck, Sanofi Aventis, Johnson & Johnson, Bayer AG, Gilead Sciences, Regeneron, Moderna, so on and so forth. Somebody, please, in the life science community, figure this thing out. As Jonas Salk figured out the polio epidemic back in 1955 at the age of 40 and with no computer. So somebody figure this out, please. There should be a national holiday for him, by the way. But something that aside, the zone of uncertainty is still there. But I really believe that our medical toolkit come the fall is going to be far superior. That we have more personal protective equipment, we have more ventilators, we have more intensive care unit beds, so on and so forth. We don't have to shut this thing down again. This is projected deaths per day. So the previous slide was total deaths. This is deaths per day. Now, what do you see here? That come around September, as the weather turns chillier, the baseline projection is what? The deaths per day starts to climb again. And as that begins, one could ask the question, look, even though deaths per day will still be less than the peak that was achieved in April, which is wonderful, there's still A, this zone of uncertainty, and B, another source of uncertainty is how will policymakers respond when they see the number of hospitalizations and deaths starting to climb again? Will they feel that it's necessary to shut things down again? And I hear among policymakers, they're scared. They're scared of messing this up. They do not want to be blamed for opening up the economy too soon or closing it back down again too late. So one of the risks here that we need to take into consideration is the policy risk. That even if the healthcare outcomes are relatively benign, when people die, that's not benign, don't get me wrong. But even if we don't get back to the death rate that we suffered in April, let's say, the policymakers may still react in a way that shuts down parts of the economy. It is possible, it's a risk. And remember, it's a presidential election year. So any policy mistakes are magnified during times like these. What about hospital resource utilization? So the purple line here represents all needed beds due to COVID-19. The green line here, you could barely see it because it overlaps with the blue line. But the green line is ICU beds needed, intensive care unit beds needed. And then the blue line is invasive ventilators needed, and they go hand in hand, right? So often patients that need an ICU bed also need to be on an invasive ventilator. So that's why you see that overlap there. But again, baseline projections in dotted lines, but then you see the massive zone of uncertainty. Again, I'm saying the economy is not going to be shut down again. That it'll reopen in fits and starts perhaps, but by the third and fourth quarters, we're basically off to the races as an economy. If I'm wrong about that, I apologize, but B, you can understand there is this zone of uncertainty coming out of the medical community. And then finally, testing. Testing is way up in America. That was not true. If you look at the data for late March, if you look at the data for late March when we were last together, that was not true. It's certainly more true now. I'm not saying there's enough testing. I'm not saying that, but at least we have a better sense now of what's taking place in the population, or at least will, as we continue to amass more tests. So that's some of the changes between March and where we are today. Testing capacity varies widely by state. No surprise, states with large metropolitan areas like Chicago, New York, Florida, actually Illinois, which is a state, New York, home to Chicago, Florida, so on, Texas, so on and so forth. That's where a lot of the testing is being done. And obviously you have less intense testing in less urban areas because it's been less of an issue there. But in any case, we've certainly come a long way since late March. Which states are reopening and which are still shut down as of June 12th? That's 4 days ago. We still have some states that are only regionally reopened, you have various parts of the country in which, they've followed more of a regional process. And this was certainly the case in New York, for instance, where upstate New York opened up before New York City did, as an example. But, most of the country has reopened. And in my state of Maryland, the governor has been anxious to reopen and get people back at it. And yes, we're wearing masks and having to dine outside, but at least we're able to go to restaurants now. And the rest of the nation is very much in the same position. So again, I had said in late March, V-shaped recovery, you go from shutting down the economy to opening it back up. It's going to be a V. And by the way, if you look at the stock market's behavior since I spoke in late March, it's been a V. And in fact, the NASDAQ has been actually reaching all-time highs. So it's not the awkward V I talked about in late March. What I said in late March was it's an awkward V. A V is made up of two linear segments that are of two linear segments of equal length. The V I've been talking about is one in which the down segment of that V, that first segment of the V, is lengthier than the up segment. And indeed, one of the ways maybe I should be talking about this is say that I actually think the recovery is going to look more like a square root, where the initial stage of recovery is quite rapid but not complete, and then things flatten out. And that's exactly what we've seen from other advanced societies when they've had epidemics/pandemics. What can unite us? Because there's been a lot of disunity in America, and that would have happened anyway. This is a presidential election year. Maybe that's just the nature of America these days with with our politics the way it is. But look, scientists are scrambling to develop a vaccine for COVID-19 more than ever before. Pharma, biotech startups, research institutes, and universities are working together. There is some togetherness out there to develop a vaccine, identify new therapies to treat symptoms of the disease. Moderna, Pfizer, Inovio have already initiated clinical trials, but many, many others. At the University of Oxford in England, a clinical trial with more than 500 participants began in late April and seems to have some promise. According to Dale Fisher, chair of the World Health Organization's Global Outbreak Alert and Response Network, we most likely won't see a vaccine until the end of 2021. Nonsense. We're not going to make these researchers go through all of these loopholes. I mean, through all these, through all of these, what's the word? Whatever, loops, hoops, whatever. They're not going to make them go through all that. We need a vaccine. According to the Milken Institute, there are currently 161 vaccines in various stages of development. And I really believe that we'll have one by the end of the year. I know it might prove to be naive, but we've got some life sciences companies say that not only will we have a vaccine by the end of the year, we could have up to 1 billion doses in place. Can you imagine? So, and you can imagine what the economy would look like if that, in fact, came to pass. So what's coming to America? Look, it's still the worst quarter of our lives. And as I said in that, roughly 3 months ago, if you look at this recovery in the form of days and weeks, it's not a V, right? Because, we're going through these episodes of, all of a sudden Florida has a bunch of new cases, and Texas has a bunch of new cases, Beijing, China has a bunch of new cases. So it'll look erratic from the perspective of days and weeks. But I'm speaking about it from the perspective of months and quarters. And from the perspective of months and quarters, this thing is going to be, quite rapid rebound in activity, again, as the retail sales data from last month showed us. Many economists, though, now forecast that COVID-19 will end up inflicting greater economic pain than they had previously expected as of, let's say, late March. So if you look at the forecast for the second quarter of 2020, here they are, economists at JP Morgan Chase, 40% decline in GDP on an annualized basis for the second quarter. Conference Board, something similar. Actually, by the way, the Conference Board's forecast is an improvement. Their previous forecast was that the second quarter GDP would be 44.5%. So 39.5% is actually an improvement from that. But setting that aside, this is the worst economic quarter of our lives. By comparison to the worst quarter of the Great Recession in late 2008, the economy shrank 8.4%. That was a baby. Oh yeah, it crushed the U.S. construction industry, but that was a baby compared to this. Now, the third quarter and fourth quarter, my expectation, very rapid bounce back in economic activity. Now, if we want to talk about construction here, let's spend last few minutes talking about that. This is non-residential construction put in place. These data are very lagged. So the last data point I have here is for April of 2020. A lot of construction projects were interrupted in April, as it turns out. I mean, I point out at the very bottom a newspaper article from Dallas, Texas, pointing out that about 70% of projects in Texas, which you'll remember was not one of the most affected states as of April in terms of COVID-19, were interrupted, suffered some form of interruption, some form of disruption. As I say, we lost nearly 1 million construction jobs in April itself, and you can see non-residential construction put in place started to fall that month. What would I expect? I would expect some recovery in May, but we don't have those data yet. As we pointed out 3 months ago, there was some vulnerability here. That if you look at the last 5 years of construction spending data, some sectors stand out in terms of the volume of construction spending. Now, public safety is at the top here because you remember all that spending that took place at the Javits Center, turned that into a hospital, or convention centers in Denver, Baltimore, elsewhere. For construction data purposes, that was all put into public health. You might have thought that goes into healthcare, but it didn't. It went mostly into public health. So that's why you say most of that 60% increase in public health construction expenditures over the last 5 years, April 2015 versus April of 2020, which is what I'm showing you, most of that happened over the last year. But then after that, lodging and office, hotel room construction, office space. So we built a lot of that kind of property, that kind of real estate before this crisis. And you can imagine what's happened to hotel occupancy around the country. And, by the way, you can see also people want to get back to it. When the casinos reopened in Las Vegas, guess what happened? People lined around the casinos to get in. They're desperate for it. One of the reasons the stock market has risen, this is one of the thoughts about it, is because gambling has not been available to people. They've been putting their money in the stock market. Might as well gamble on Pfizer if I can't gamble on the number 4 horse in the 13th race. So we had some vulnerability because we built a lot of things in segments of construction that are vulnerable from a real estate perspective, office space, vacancy rates, these kinds of things. I still think it's going to be a V-shaped recovery. This comes from Oxford Economics Global Outlook. The blue line there represents their current forecast, at least the forecast through May. The red line represents their pre-existing pre-COVID-19 forecast. It's an index of global economic output. And what it basically shows, that blue line is, you see the sharp drop off in that blue line in global economic activity, and then the sharp bounce back, the V. One of the reasons I think it's going to be a V is not just because Oxford Economics says so, we put so much stimulus into the economy, right? So when we were talking in late March, we had seen basically 2 phases of stimulus. We saw the $8.3 billion phase 1, which was largely to shore up the healthcare capacity. And then phase 2 was passed 12 days later. So you might remember that during the Great Recession, after the failure of Lehman Brothers, Congress heed and hawed. When the TARP vote came up first, the Troubled Assets Relief Program, they voted it down, and the markets collapsed. This time, they didn't wait. No. By March 6th, which is 3 days before that Dow Jones decline on March 9th, 5 days before the Utah Jazz are ushered off the basketball court, when their all-star center, Rudy Gobert, is diagnosed with COVID-19, and around that time, the NBA scuttles its season. But 3 days before that March 9th decline in the Dow, they're already at it. 12 days later, phase 2, a $192 billion package, that, among other things, provides paid sick leave. Then phase 3 comes right around the time that we were gathering, the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, more than $2 trillion, $2.2 trillion package. That includes loans to small businesses, that Paycheck Protection Program, but because that program ran out of money, they went to phase 4 less than 1 month later on April 24th, phase 4, and now there's talk of a phase 5. And whether that will take the form of infrastructure, assist state and local governments, which have to balance their budgets every year, that's unclear. That's a political outcome, but we're going to get another stimulus before the election. And you may say, well, we have this national debt, we can't afford it. Okay, yeah, but it's a presidential election year, and both parties have to appear sympathetic to the American people. You may view them as unsympathetic, but they have to look sympathetic, at least in their own minds. I think we're going to get another stimulus, and that's, as I say, one of the reasons the market's up today is because there's all this talk about $1 trillion stimulus package for infrastructure. So, I'll give you another statistic here. So, because the federal government sent that $1,200 check to many families in April, or many individuals, and because some people have been getting, if they're unemployed, $600 unemployment insurance benefits from the federal government on top of their state benefits, they were stockpiling cash. So the U.S. household savings rate went from 8% in March to 30% the following month. And so guess what? As stores reopen, households have a lot of dry powder. And you can see that will translate into that surge in retail sales in May. And that, I would guess, will continue to June and July. So conclusion outlook, good morning economic expansion. One could argue it's already begun. Whether you look at retail activity, jobs, so on and so forth, let's play on Good Morning Vietnam, starring the irrepressible and amazing Robin Williams. The initial phase of recovery from this crisis will be sharp, profound, and most welcome. I said that last time. I'm absolutely correct. And I love to point out to Kurt members and whoever else will listen to me when I'm correct. Look, as people re-enter the economy, guess what they see? Low interest rates. There's pent-up demand for automobiles and all kinds of things that people were thinking about buying in January, February, and they just postponed it. There's a need to rebuild inventories, including auto dealerships, but in many other places. And people are anxious to meet again, go to restaurants, casinos, see a movie, watch the Baltimore Orioles, which is the most beautiful thing a human being can do, short of nurturing a child, and engage in other most wonderful of human activities. And you can see it, you can feel it. May's jobs report was an absolute stunner. one way to look at this is to say economists missed the mark by 10.5 million jobs. Another more charitable way to look at it is that economists missed it by 2 weeks. The economy opened up sooner than we thought. And then while the recovery has begun, these remain treacherous times. So to think about as we head into the fall. But I've given you my baseline forecast, a V-shaped recovery, a partial recovery, but a V-shaped recovery nonetheless. And with that, I'll give it back to Greg.
Thank you, Anirban. I appreciate that. Comment, if you will. And by the way, we have questions on the group chat over there to the right. And I'll repeat those and give you a little bit of time to assess them. But what about inflation? What happens here with this money being printed and sprayed into an already or formerly hot economy? Are we in for some inflationary spirals in the coming years?
That is a great question, Greg, and I'm happy somebody asked it. Yes. So it's not now. As Jay Powell, our Federal Reserve Chairman, suggested today, right now we're seeing actually a decline in inflation. We're seeing disinflation. If you look at measures like the core CPI, the core consumer price index, for instance, which was running around 2% pre-crisis, it's running around 1% now. That's one of the reasons interest rates are so low, is because inflation is actually falling. But there's an equation in economics, M times V equals P times Y. If it is a logarithm of that, it becomes percentage change M plus percentage change V equals percentage change P plus percentage change Y. What does it mean? Percentage change M is change in money supply. And we've created a lot of money supply. And what that equation basically says is that if you increase money supply in a society, one of two things can happen. Both can happen, but there's two things that can happen. One, output goes up. Output goes up. So you increase money supply, output goes up, which is what you want. Here's the problem, Greg. Output is constrained by what? By some things I haven't talked about. Like the fact that the labor force participation rate has sunk. A lot of people appear to have left the labor force permanently or semi-permanently. To be part of the labor force, you have to be either working or looking for work. A lot of Americans have dropped out of the labor force altogether. They joined the labor force during those great years, 2017, 2018, 2019, when wages were marching higher, and there's all this talk about a great economy, and they jumped. The labor force participation rate was rising as we came into the crisis. But then with the crisis, labor force participation rate has plummeted, and if you can't get workers, you can't boost output. So what's the other thing that can happen if you can't boost output? Prices go up. That's percentage change P. That's the aggregate price level. That's inflation. So I don't think we'll be talking much about inflation in 2020. We'll be talking about the prospects of inflation in 2020. But I think we'll actually be talking about inflation for the first time in 4 decades in 2021 and or 2022. I think it's coming. And inflation is really pernicious for the economy. It does a lot of damage, creates a lot of inefficiencies. And so watch for that because we've just pumped up so much money supply into this economy on top of all this federal government spending. And in some sense, we're going to come out of this too sharply, given the lack of workers that are coming back into the economy. Inflation is going to be an issue. And that means rising interest rates too, which is not good for construction.
Interesting. Can you speak to these bankruptcies, particularly retailers? Are there more coming? What's your thought, and where is the highly at-risk sector? I think I know, but I'm going to let you say.
Right. Well, no, yeah, you're going to see more bankruptcies. And oddly enough, as I say, in some cases, retail bankruptcies have been postponed by the lack of ability to liquidate inventory. So there are a lot of marginal retailers coming into this period. And look, Amazon won. I mean, let there be no doubt. Amazon won. E-commerce won. And so some players got bigger, some players got smaller, but e-commerce won. And so as a result, what that means is that a lot of retailers who were fragile before are even more fragile now. That's why you're going to see some really uncomfortable things on Main Street. You're going to see a lot of vacant, storefronts, darkened storefronts. And we've become so accustomed to seeing, vibrant main streets across America, whether in large cities or small towns. We've become, because consumer spending was strong and it supported both e-commerce and the retail or brick and mortar economy. That has changed. You're going to see a lot of retail bankruptcies. I think you're going to see a lot of bankruptcies of commercial real estate investment trusts, right? Because one of the things that's happening out there, people are not paying their rent. And a lot of companies, in fact, some of the strongest companies financially are trying to renegotiate their rents, including players like Starbucks. So to the extent that cash flow has been weakened, balance sheets are not as strong, you're going to see some bankruptcies there as well. And so, yeah, I mean, more bankruptcies to come. And, bankruptcy is a complicated process. It takes a long time to find the lawyers and file for bankruptcy, so on and so forth. So even if you haven't seen a lot so far, as I say, we've seen J. Crew, J.C. Penney, Neiman Marcus file, but you're going to see a lot more going forward.
So the $1 trillion infrastructure that Trump's announced as a possibility, do you think it'll come to us? And if so, where is it going to be sprayed to? Any thoughts as to where it might be spent?
All of it will be spent in Ohio. Last dime will be spent in Ohio. No, usually with these packages, it is sprayed around the country. Look, the president probably has some states that he favors above others. That's my guess. But there are some swing states. I mean, Michigan and Ohio, you know what they are. Virginia, so on and so on, Nevada. But generally speaking, when you look at whoever's in charge, let's say we had the stimulus package passed in February of 2009. I mean, it's the American Recovery and Reinvestment Act of 2009. It was roughly a $770 billion package of stimulus. Not that much money went to infrastructure, as it turns out. Less than 200 billion. But that money was sprinkled around the country. They're looking for shovel-ready projects, and so whoever could put up shovel-ready projects got money. So I would think, given that we have a Democratic House of Representatives and Congress still has to be on board in terms of passing such a package, that it'll be politically fair and that it'll be sprinkled around. And then hopefully states and localities will be given some control about how they spend that money, because in Iowa, the issue is rural bridges, perhaps. In my state, it's the Howard Street Tunnel and not being able to double stack containerized cargo coming out of the Port of Baltimore. Whatever the issues are, localities know best.
States are in trouble, many of them. One right next door to us, Kentucky, doing dismally poor. How critical will it be for the feds to undertake some state support?
I think it's critical. So hopefully as part of this package, they pass some relief to state and local governments. Now, Kentucky came into this with one of the most underfunded pensions in America. I mean, really bizarrely underfunded pensions, state pensions. So Kentucky's had issues, but you've heard a lot from politicians who have said, we don't want to bail out New Jersey. We don't want to bail out Illinois, which sends half of its governors to prison. I get that, but this is about bailing out states. The federal government does not need to balance its budget every year, and doesn't. State and local governments, at least ostensibly, have to balance their budgets every year. They can play games with trust funds and so on and so on, but they have to balance their budgets every year. So you can see what revenue declines have occurred in March, April, May in New Jersey, Illinois, Kentucky, Oregon, whatever it happens to be. And so the federal government could help backfill at least some of that loss. Because if we start losing police officers, firefighters, garbage collectors, teachers, they start losing their jobs, that's going to weaken the recovery to come. We don't want that. And by the way, the federal government can borrow at a very low rate of interest right now. So yeah, I'm worried about the national debt. The 10-year treasury yield today is 0.754%, at least it is as I'm speaking to you. So that's a very low rate of interest, actually below inflation, as it turns out. So it is perfectly, I think, acceptable from a policy perspective for the federal government to borrow money cheaply, give some relief to state and local governments so that firefighters, teachers, others don't lose their jobs, and we can continue with a smoother economic expansion.
Got it. Thanks. Another one asks, the American Society of Civil Engineers predicted about an 18-month negative impact on construction recovery due to decreased revenues, gas, tolls, etc. And everyone's staying at home. Do you think that that's going to be the case, or not?
Right. Absent a stimulus package, they're absolutely correct. As people know, the American Society of Civil Engineers is really top-notch in terms of its analyses of all kinds of things, infrastructure financing, so on and so forth. They're the ones who in 2017 graded America's infrastructure a D+. Very detailed report, beautifully written, all of that. Yeah, typically the lag between a recession and the downturn, the depths of downturn in public construction is 12 to 18 months, but more like 18 months. So absent some relief from the federal government, because states are going to have to race to close their budget gaps for fiscal years 2020 and to 2021, that leaves less money for infrastructure. And by the way, it also leaves legislatures and governors more risk averse. Because the last thing you want to do when you've taken a hit like this is take on more debt and create more uncertainty. Because you make a mistake along that fiscal dimension, that gets into a newspaper, that costs people re-election. So again, that's another reason that the federal government really needs to step in. And by the way, by providing more money for infrastructure, that's actually a way to help states with their fiscal budgets. Money is fungible. I know there's capital budgets and operating budgets, but in some sense, money is money. So there's that.
What about the civil unrest? What impact does this have on our national recovery?
Oh, very good question, Greg.
Not my question. It was from Luke.
Oh, well, very good question, Luke. A very good question, and one I wish no one had asked. Because, you know, you get into some pretty treacherous material when you're talking about this unrest and what's going on. I'll tell you, there's a lot of things to think about. One is, I don't think the impact will be that great. I know the people of Seattle decide they want to give up 6 blocks or whatever it is, and on TV it looks visually stunning to see a Wendy's on fire or, you know, a Target being looted or whatever it happens to be. But in general, and I'm from Baltimore, I know something about this stuff. In general, small parts of cities have been affected, and economies can still perform. And by the way, as it turns out, to rebuild a Wendy's or a Target or so, that actually adds to demand for construction services. You know, the people who get hurt are insurance companies, because they're the ones who are funding that for the most part. But so I'm not, you know, I think the bigger issue is the disunity across America. One of the things I'll be very interested to see going forward, very interested, is to see how hiring patterns change going forward, especially for a minority. Now, I don't know if you can see me right here. This is what I got going on here. I'm one of those people of color people talk about. I'll be very interested to see what happens, whether this causes corporate America to really jump in and provide more opportunities to certain communities, or whether there's a different response. I'll leave it at that. Mm-hmm. To watch the African-American unemployment rate over time, to watch the Caucasian unemployment rate over time, Asian Americans, Hispanics, so on and so forth, and to see if there's any change in hiring patterns post-unrest versus pre-unrest. I mean, I'll just be very interested, and I'll leave it at that.
Someone else asked about this reshoring of manufacturing. What does this mean? New capacity, requiring new facilities, bringing back production to existing facilities. What's going to happen there with the reshoring initiative, and is it real?
The reshoring initiative is absolutely 100% real. 100%. We've already reshored hundreds of thousands of jobs since 2010. So the decade of the 2000s, the initial decade of the millennium, was a period of significant offshoring, as it turns out. A lot of offshoring. The next decade, the decade of the 20-teens, was a decade of significant reshoring. And if you look at surveys of CEOs that do business in China, or at least have part of their supply chain in China, so on and so forth, you'll see a remarkable appetite to decouple from the Chinese economy in terms of the supply chain, for all kinds of reasons. The Chinese manufacturing worker is much more expensive. The issues around intellectual property, the presidential tweets, whatever it happens to be. You know, surveys conducted over the last just 6 months show there's been a radical change, a shift in the attitude of many CEOs with respect to the prospects for decoupling supply chains increasingly from the Chinese economy. So you're going to see more of that. Now, who gets most of these jobs? The Southeast and Texas. That's where we see a lot of the reshoring jobs go. But there's one state that stands out that also gets a lot of reshoring, that is a northern state, that's Michigan. So it's absolutely real. 3 decades ago, the mantra in corporate America was, if you want to minimize costs, at least if you're a manufacturer, if you want to minimize costs, you better move your supply chain to China. Because if you want to maximize profits, you have to be a cost minimizer. And if you want to be a cost minimizer, you got to move to China. Now the mantra is, I need to be closer to my customer. I need not to be so susceptible to the whims of the Chinese government. I need to take advantage of this resurgence of American vocational training and this notion that maybe college is for a lot of people, but not for everybody. And we need to have a productive workforce, whatever it is they're doing. And there are many paths to success, including being a machinist or a mechanic or a millwright or a welder. So anyway, that is real. And my state of Maryland has not really taken advantage of it. There's all kinds of issues. We're not a right to work state. Maybe that matters, maybe it doesn't. But a lot of the states like Texas and Michigan are right to work states that have attracted a lot of reshored jobs. So, anyway, that's a debate for a different day, but it's real. From a national perspective, it's real.
What do you have to say to, or what would you encourage client or contractors to say to their clients to encourage them to move forward with their projects? Money's cheap. Workforce may still be an issue. In fact, there's a lot of thought that says workforce shortages are more profound now than they were in February because of people leaving the workforce or reluctant to return. What would a big multinational contractor say to their client to get them to move forward in the midst of all this uncertainty?
I would say this. So, Greg, there's a lot of discussions right now, have been a lot of discussions between project owners and general contractors. And the conversation has gone, I think, in many cases, something like this. Look, we bid out this project with you, general contractor, in November, December, January. It was before COVID-19 hit the economy. The economy is much weaker now. I'm going to rebid the project because I'm going to get a lower bid. Or maybe I'll postpone the project, I'll rebid it at that point, and I'm going to get a lower bid. Either way. When you look at construction cost indices, look at construction cost indices, and there are many of them, right? The cost of delivering construction services during and after the Great Recession. Did construction costs decline? No, they did not in any meaningful way, and not for a prolonged period. Why? Because while the demand for construction services dissipates with economic downturns and thereafter, what also dissipates is the capacity to supply construction services. So I'll give you an example. A lot of construction workers lost jobs during the Great Recession. The government, the federal government, did a study, and I believe it's the Census Bureau, but I could be wrong, but they did a study of what happened to construction workers dislocated during the Great Recession. And they found that between the Great Recession and 2013, the study came out in 2015, that between the Great Recession and 2013, 60% of those construction workers who lost jobs during the recession did not come back to the construction industry. They either found jobs in other industries or they left the workforce altogether. So you've got to be careful. Coming out of this, you're going to see some subcontractors falter. You're going to see a lot of workers leave the industry, because construction typically is one of the last sectors to fully recover, right? So when you put that together, right now you've got a group of subcontractors that are still operating. You've got a workforce that's still there. If you're an owner of a project, you may want to take advantage of that because in a year or two, it could be a very different picture. So, that's what I would say. And actually, it's borne out by the construction cost indices that are produced by various people operating from various, perspectives. And that's what the experience has been during previous downturns as well, not just the Great Recession. So that's what I would say.
Thanks. Gas prices have been $1.25, as low as $1.25 here in Ohio. They're now $1.99 in Ohio. Are the oil companies taking advantage of people going back to work? Are they trying to improve their cash flow, or is there another reason for the spikes in the gas prices recently?
No, look, what has happened here in the last few months? So you might remember that early in the crisis, oil prices for a time went negative. Right, the May futures contract in April went negative. Oil, you had to, if you had oil on a ship, you had to give someone money for them to unload the oil, onto your platform, because there was just no storage capacity. That's where we were. Now, as we're speaking, roughly 3 months later, oil is trading near $40 a barrel. And one of the reasons for that is that OPEC has cut supply. OPEC and what's called the OPEC affiliate. So countries like Russia, which are not necessarily OPEC countries, but they sort of tag team. So they have tried to truncate supply. What's the goal here? To undermine the U.S. shale producers. It's a war on the U.S. shale producers, who are wickedly efficient. America's the leading oil producer in the world. It's not going to work. Oil, actually is trading at $37.33 as I'm speaking to you, West Texas Intermediate. But so that's why you see that increase in gasoline prices. It's a function of oil prices increasing. And when oil prices go up, gasoline prices would tend to go up. So I don't think it's anyone trying to take advantage of the market. Gasoline, the purchase of gasoline is very competitive. Why? Because if you have a gasoline station on one corner, you probably have another one on the next corner over. So you can see the prices. They're in really like 6-foot signs telling you what the prices are for regular and Supreme and all that. I buy Supreme, by the way. So that's why. I don't think anyone's trying to game the market. It's economic realities, I think, for the most part.
Final question, and we're right at 12 noon, so indulge us for 60 seconds or 90 seconds more. The elections are months away. It seems like there's been a big halt on campaigning for all offices, federal and state. What is the impact of the election on recovery? Are we better off or worse off with the incumbent? Or what's your feeling? Again, not endorsement, just analysis.
Boy, we should have stopped right at 12. We really should have. I think timeliness really matters. So great question. I think it matters, right? Because look, what matters most, I think, is who wins the congressional races. Because let's say it's a Joe Biden, but Joe Biden wins with the Republican Senate. What's he going to do? He's going to be, hands tied behind his back. Let's say it's Donald Trump with the Democratic Senate and House of Representatives. What's he going to do? There's still a constitution. There's still a separation of powers. And I would argue to you, if you look at what Donald Trump accomplished during his first 2 years in office, it was actually more significant than his last 2 years in office, right? Because Democrats won the midterm elections to a certain extent, and so he couldn't do as much. The tax cuts were passed in late 2017, right? It was first 2 years in office. So who wins the congressional elections? If Joe Biden and the Democrats sweep, and I'm not trying to be partisan here, I think the first thing they'll try to do is roll back the Trump tax cuts. Because there's blood in the water politically. Just as Donald Trump came in and tried to wipe out the legacy of Barack Obama, including Obamacare, immediately, I think the Democrats will try to do the same thing to him, erase him. And some people might think that's good policy, some people think it's bad policy. I'm just saying it's a likely political outcome. So, watch out for that. Because to the extent that the Trump tax cuts have been good for corporate America, if they're rolled back, that would tend to soften the recovery to come, wouldn't it? I would think so. So anyway, that's my answer to the question. I've indulged you enough.
You have indeed. It's 12:02. We're 120 seconds past time. Anirban, as always, it's a joy and delight to hear from you. Thank you so much. We'll have you back again, I'm sure, before the end of the year. For those on the call, again, we'll have a follow-up email coming out to you later today with Anirban's contact information, the slide deck that he's provided, and other information that we deem prudent and important. Keep in mind, again, the April dates. Our next meeting, April 24th, for the quarterly events online. It's going to be virtual. And so make plans to join us the 24th, 25th, and 26th. With that, I will bid you a good afternoon, at least here in the Eastern Time Zone. And thank you so much. Take care of yourself and each other.